Welcome to episode 48 of Accessible Finance, where we demystify personal financial topics and answer your questions you leave saying, I get it now. I'm Eric John.
And I'm Rachel John.
Let's dive in.
All right, so we are now officially on part 3 of Eric reacts to random quotes and headlines that Rachel has curated from the internet.
I'm excited. Let's go.
Wonderful. Okay, this is a quote from the National Foundation for Credit Counseling.
All right.
It says, paying off debt is more important than saving for retirement.
I assume they're talking about personal debt, in which case I don't really disagree strongly. I would just caution the idea that paying off debt, for example, if you have a mortgage rate that's locked in below, say, 4%, there's arbitrage to be made there if you're willing to just continue to make your mortgage payments and invest what you would otherwise be overpaying towards your mortgage in even a CD, right, or a money
Right.
market account right now. So not always.
Mhm. So,
Generally speaking, though, I would also say that you would want to take your employer match before paying off even personal debt.
free money.
Does that make sense? Yeah,
Yeah,
take the free money,
right.
even if you have to take like non-qualified distributions for it or hardship distributions to try to make loans with it. Basically, we could try
Right
to,
for the 401k.
yeah,
Yeah.
there are plans, there are strategies you can implement that would allow you to have access to that money of a reduced amount of that money, and you're
Mhm.
still going to net positive. You're basically taking, like you said, free money,
Yeah,
even if you're even net of all the penalties that you would
correct. You
incur
still end
from
up
early
ahead.
withdrawal, right? So,
Um,
so yeah, again, absolute's probably not going to work.
Correct. So not wrong, but also not really right.
Correct.
And just being aware of what the interest rates are matters so very
Correct.
much.
Correct.
Compare that to the returns you're getting on whatever
I
retirement
would say
savings
though
you
that
have made.
if we're talking personal debt, which I assume we are, and we're talking rates north of 20% or
They are talking
in
personal
that
debt.
ballpark, right?
Yeah.
So we're talking personal debt. Um, it is better to pay that off than to contribute above the match. Like I would agree that it's
Correct.
better to than extra savings for
You
retirement,
certainly
for
don't want to
example.
be
You don't want to be
taking the debt to save for
you don't want to
retirement.
be you don't want to be taking essential loans at 20% to try to you don't want to be trying to beat a 20% return
Yeah,
with your retirement investment. Does that make
exactly.
sense? So
Exactly.
like you're guaranteed to be losing this 20% that we have to pay on our debt
Correct.
interest. But we don't know what our return is from the market or from
Yeah,
whatever we're investing in
exactly.
from our retirement investment instruments. So trying to jump trying to beat the 20% a year hurdle, good
Right.
luck. That's not happening.
Exactly. But so trying to pay off credit card versus trying to like early pay off your mortgage.
Very different scenarios. You
Correct.
got to look at them individually.
Love it. All right. 360 Financial Editorial. Are you ready for this one?
Never heard of them, but go on.
All right. Well,
They probably never heard
it's
of me.
360 Financial, but it was an editorial article
Got
at
it.
360.
Still never heard of
Okay. You don't need a financial plan if you have a good job.
them. Oh
Yeah.
boy. Yeah, this one takes the cake. The other
Yeah.
one I thought I
You
was
thought
laughing at
it
it
was
because I
bad
didn't think it applied to me, but
before.
this one, boy, this is
Yeah.
something.
I was floored.
No, that's not true
Yeah.
for a number of reasons. For one, we've said this many times. The highest earners tend to spend the most, and it's not necessarily proportional to their distance from median earnings. That was probably the most complicated way I could have expressed the sentiment that I'm trying to express, which is spending matters a ton.
Correct.
Spending matters more than earnings. Okay, so if you're unable to restrict or adjust your spending in any way, if it's going to increase at a faster rate or if it
Right.
just exceeds your earnings, you are losing.
Also dare to say that people living paycheck to paycheck have a pretty firm grasp on what their expenses are, what their finances are, because they
Yeah,
have no choice.
I agree.
Whereas people who are
No, they don't even look.
correct,
They don't even look.
correct. So I think that there's a certain luxury that comes with being better off where I mean, we've said this before. When we're working with clients, oftentimes when they try to give us their estimate of their monthly expenses,
No,
it
it's
is
never right.
right. And that's
It's not their fault. It's
okay.
normal.
Exactly. It's okay. But that's human nature,
Mhm.
right? Like we forget about the
Almost
$300
everyone
you spend at
underestimates.
Amazon.
Yeah, yeah, almost
Yeah.
everyone underestimates, and they'll
Yeah.
think about things, they're like, "What is my mortgage? What is my
You're
utility
thinking
bill?"
about your consistent
Right,
expenses.
and they're gonna ballpark groceries,
Mhm.
but then they just kinda dining out, entertainment, those kinda categories, shopping, they get, maybe I spent 300 a month on shopping." Well, they haven't really looked, and it
Correct.
might be like, 1,000 too, whatever. Some people
Exactly.
spend 10. Um,
Also, like theoretically, everyone can benefit from a financial plan. Like without a doubt, I think it's fair to say everyone can benefit from a financial plan. The
Right.
reality comes when you realize like, is getting a financial plan or is the working with a financial planner going to be something that generates more value than cost,
It's
right?
also it's also kind of important to take a step back and talk about what we're when we consider a financial
Correct.
plan,
What are they
we're
defining
talking
as
about
financial?
estate planning.
Yep.
So we're talking about like will and potential trust administration in your estate, meetings with estate attorneys and CPAs
Correct.
there, right?
Investment
Like
allocation.
it's not just retirement planning and investment planning.
Correct.
It's
A
also
lot of
tax
tax
planning on a yearly
yeah.
basis. So, is the implication that if you have a good job, you don't need to worry about taxes? Like that's laughable, right?
Yes.
That's not true.
Those are
But
people the IRS love to
right.
sell it in.
Additionally, insurance planning, right?
Yep.
So if you have a great job, you might need more disability insurance,
Mhm.
right? And you might need more like term life insurance if you're trying to
Correct.
provide for your family. If you're the doctor and you're making 600, 700K, but you're married to a stay-at-home husband, for example. See, everybody thought that it might be applying those to you.
That I like that.
You like that? Pretty
Reverse.
tricky, huh?
Yeah, look at
So the
you.
idea is, if that's the case, right? You would want, like presumably your husband in this case would want
Correct.
you to have a pretty huge term life policy
Correct. Because what
and a
happens?
pretty huge disability
Yeah.
policy. Because if you're used to taking home, 700K a year, and that's
We'll
just
stay at
now it's goose egg,
yeah.
it's problematic.
That's a
So
yeah,
we would really want to be thinking about the insurance planning, and that is financial planning. That is
exactly.
the definition. It's very
And
much a
I do
part of
think
the
that's
CFP
all
coursework.
exactly. Like I would have loved to ask the person who was writing that article, like, define a financial plan for me. Like,
Yeah,
what are you interpreting as a financial plan? Because like
right,
we've said, there are people out there who will call themselves financial planners who are not. Um, or they might deliver a financial plan.
right.
Um, but
That
it's
just
not,
says save 2% a year. So,
right?
it
Or
just
buy
says save
this
20%.
insurance plan. Like,
Right. One
so yeah,
one of the other points I would make, and not to belabor this, yes, this quote is not great.
it just
Um,
means so much.
the the higher you're spending, and typically the higher you're earning in this case, they're implying that if you earn, you can basically out earn the necessity to plan, right?
Correct.
That's essentially what we're saying. The spending needs that you will generate, or I'm sorry, the amount of capital that is required for inflated spending needs, it can be very substantial and is often overlooked. Does that make sense at all? So, like, Social Security
Yeah.
does a pretty good job of providing baseline coverage, but there's a cap on how much you will receive. If I make $700,000 a year and I receive Social Security
Mhm.
of, say, let's even call it 100K,
Yeah.
which would be higher than Social Security would pay out. But let's call it 100K.
Right.
That is lower as a percentage of my salary than if I make 60K and then Social Security pays me 40K. Does that make
Correct.
sense? We're not even close to the
You're
same problem.
having to cover a bigger margin. I will say
So I would need a huge amount of capital in that
correct.
case. Whereas if I'm making maybe even 40K, but all I need is 30K to spend, Social Security might be giving me 36. I might actually be netting positive when I'm taking Social Security.
Correct.
Does that make sense? Right? Like,
One idea is like
safety nets are meant for
two.
the lower, end of the
Correct.
spectrum because they're just supposed to cover minimum costs.
Correct. One and ultimately and ideally, like if you are making more money, right? If you have a good job, if you're making a lot of money, you still shouldn't be super excited about like suboptimally putting those dollars to work for you. Like the idea
Yeah.
of being unintentional with the money is certainly not
Correct. Yeah, yeah. We're just gonna negate
right.
tax planning and
I'm
hire.
just gonna hope for the best. I will say, you mentioning the Social Security piece reminded me of some. It was random, just Joe Blow on some forum. Replied and said, I don't understand why people are so worried about retirement accounts. That's what Social Security is for. So I was going to put that there, but I would hope at this point that we've covered enough. I felt like it was a waste of airtime, but here we are. But I would hope that we have covered enough that Social Security is, like you said, a floor to
Right.
build upon, not a retirement income like replacement.
Correct. It very
It just
rarely
it
will be.
yeah. Okay. So this is my favorite section. It's got all sorts of goodies.
All right.
These were viral social media advice pieces that I have seen touted all over Instagram, TikTok.
Sure, this will be fun.
It's super great.
I'm not exactly active on this, so
No, but they're things that don't really originate with one person, but people are resharing. It's just like uh, it's wild. It's caught on like wildfire. Okay. Invest in stocks only if you can afford to lose all the money.
I do not think this is accurate for a number of reasons. One, historically, if we look at it, well, I would say individual stock picking is significantly more risky. I mean, it's more just absolute speak that
Correct.
misses the point and is kind of going to steer people in the wrong direction. It's probably overstating the risk that stocks present. Individual stock picking, I would say, maybe could fall into this, right?
Yeah.
And it's just the wrong way to look at it for so many reasons.
Well, I thought about it in terms of like we talk about the risk that you can tolerate versus the risk that you need to take.
Correct. Yeah, risk tolerance versus risk capacity.
Correct. And so there are people in situations that cannot afford to lose the money, but also cannot afford to not invest it.
Right.
Sometimes you're in a position where you have to take some risk because you just have to get more.
Absolutely agree. Absolutely agree. Especially when we're talking about things like retirement accounts. And we've seen this, and it's not great. There are people that individuals that are working, right? And they're just unsure of where to put their money. They have a 401k at work. They know they've heard from their friends or social media or maybe our podcast, and it said contribute up to the max to
Right.
the employer. I'm sorry, not to the max, to the employer
Match.
match.
Yeah.
Okay, so they're contributing their 6, 10%, whatever it is, they're contributing to their 401k, their active accounts, and then you look at the securities or the investments that they've selected within their 401k, and a lot of times it's cash equivalents or just bonds, right?
Mhm.
So they're thinking like, well, I'm not taking any risk. And the idea is that they're missing a huge amount of growth because they're not participating in the markets that are going to grow the most historically over time and
Mhm.
have the most potential to grow, right? Like corporations in America and internationally are incentivized to maximize their profits. They're incentivized to earn more every year. That's literally their fundamental purpose. So they're more likely to appreciate in value, whereas, bonds can lose purchasing power over time, et cetera, et cetera. None of that. But the point is, you're going to need to invest in equities, right? Like there's a number of reasons we've talked about, equities being hedges against, purchasing
Yeah.
power risk. And
Exactly.
you're going to have to, well, not have to, but it's prudent to be exposed to some equities in your portfolio.
Hmm.
Almost never will we, recommend a 100% fixed income or equity to fixed income portfolio.
Right. That's not to say there wouldn't be a scenario,
No, someone's just
but
like, look,
it's
I'm not doing this. That's fine. I just think
we
this is
still have
overstating.
conversations.
Yeah, this is
Exactly.
overstating the risk, especially particularly if you're investing in the global market,
Yeah.
right? If you're investing in a globally diversified
Yeah.
equity portfolio, this is essentially saying to you, every company in the world will go out
Go
of
bankrupt.
go bankrupt.
Exactly.
However, I would also say though that we would never put clients in the equity markets if we can't afford to lose some of the money, or if we can't afford some fluctuation in those investments, particularly in the short to intermediate term.
Correct. Like we would never say, let's invest your emergency fund.
Absolutely not.
So
So
there's
that's just a better approach,
correct.
and it's not just only invest in stocks if you can lose money. That's
Correct.
not the approach. That's not the way to look at equity investments.
Hmm. Love that. Next was buy as much house as you can since they always go up in value.
Yeah,
We touched on this one a little
tell
earlier,
that to 2008.
right?
No,
Yeah.
not no.
So correct. So this
No
was the
market always goes up in value, particularly without turbulence along the
now I
way.
will say I think that the reason that this became so proliferated throughout social media is that the people who are resharing this are young. They
Yeah.
have only lived in
They've
just
only seen the boom since '08, right?
correct. They've
So,
only seen what their
and prices are
parents
going
might have
straight up.
exactly. You're seeing what your parents bought the
And
houses
now
for
they're
in
realizing,
'86.
yeah, and they're priced out of the market. So
Exactly.
naturally they're upset and they're
And
saying,
they're thinking houses
if
are
only we had, hindsight
correct.
2020, bought as much as we could back then, we'd be great.
Exactly. Okay. Higher risk means higher returns, so always pick risky stocks.
I mean, always pick stocks. I just pick stocks is just where I draw the
Just
line
leave
there,
the word risky out
right? There's
altogether.
clearly a correlation between risk and return in finance. That's one of the fundamental tenets of finance,
Sure.
right? Higher risk should equal higher return, all else equal, at least on a risk adjusted basis. So that claim is not wrong. Pick risky stocks is I mean, no, don't do that. But
Well,
also like you should think about where you're doing it. Like account asset location matters. Like what accounts are we doing this in?
so we're not
Time
gonna like
horizon matters.
what is making it risky? Like not all risky stocks are risky for the same reasons I
I
think.
mean, I'm assuming that we're talking about like standard deviation beta type analysis, but I doubt that
You
we're
can
going
assume
that deep.
I was gonna say you can
I doubt
assume
social
that
media and TikTok are really going that deep, but I
correct.
don't know. I don't want to discount the validity of their,
No,
one-liners.
agreed, agreed. Okay, next up was it's better to invest in your taxable account than your 401k since you can't touch it till you're 59 and a half.
No, no, that's not definitely incorrect. That's factually inaccurate. Um, what? What?
I love it. I'm gonna make you go on TikTok.
Yeah.
Hmm.
What is that gonna? Well, we'll
Hmm.
go. We'll
You
talk
go
about
viral for all the wrong
it.
reasons.
Yeah, exactly.
Okay.
Just trouncing on people and then ruining their
Um,
days.
so why no? Why no?
Why no? There are tax advantages for a 401k account, right? You're going to reduce your taxable income by the amount of your deferrals to your 401k.
There's also typically matching.
There's a matching component, right? Like, yes, that is correct.
Like
Um, your brokerage account, we would actually say once you've sustained, oops, once you, sorry, it's
every
necessary.
time.
It is necessary.
I don't think I
Have to
get through
have
an
it.
episode
Have to
without
have
it.
it. So once you've filled your brokerage account with a sufficient amount of assets to accomplish your goals, right? What I mean by capital goals. So I mean, maybe you've got 3 to 6 months of emergency funds.
Hmm.
You have your next capital expenditures covered. Let's say you're going to need a new car, you've got that covered. You're going to need a down payment for a house, you've got that covered. And maybe you still have extra in your brokerage account. We would actually be trying to find ways to match the timing of your need for the additional dollars. Okay.
Right.
We're assuming you have like a large sum. Maybe you have 300K and that's going to cover the capital expenditures we just talked about. That covers your emergency fund. We would actually and you maybe your account, we said you need, let's say 200K. Your brokerage account has, let's say 500K, right?
Hmm.
We would be looking for ways to shift that additional 200K into an account that matches the timing of your expected need for that 200K. Does
Yeah.
that make sense?
Hmm.
Maybe I don't even know when that need is. So if I could get that money maybe in a Roth account
Yeah.
to transfer the wealth tax efficiently to my heirs, maybe I want to do that if that's one of my goals, right?
Yeah.
Maybe I want to get into a retirement account because maybe I want to give the excess to charity and charity's not going to have to pay tax. Therefore, I can pay less tax and then the charity doesn't pay
Exactly.
tax. There is a number of planning considerations
Correct.
that it's just not even remotely close to the simple. And then it's mostly revolving around matching the actual need for the funds with the appropriate account given the time horizon
Hmm.
of the need for those funds. Does that make sense?
Exactly. And so I think bottom line, it's not an either or, right? Like
Oh, for
we're
sure.
not
No, you definitely do
saying
both.
correct.
100% do
You do
both.
all three, right? We even had, we
Correct.
wrote out, we were really awesome parents, and we wrote out a whole graph to our children to explain the three buckets. I promise they asked of their own volition. I
It was
think they
good.
heard us talking about it.
They liked it.
But each one lends itself to situational needs. And so making sure that you're partaking in your tax free, your taxable, your tax deferred is crucial for that reason.
Right. They all serve a purpose. You may be
Correct.
over or under contributing to one in a given year based on your tax planning, tax
Correct.
situations, but you're not going to just say one is bad,
Yeah,
one
you're
is
not
good.
just
That's
stuffing
not how
one.
this works. Yeah.
Exactly. Okay, this is going to be your favorite one. Everyone should have permanent life insurance. I swear it was there. And
Nobody
so
said that.
I promise you,
Oh, that's
it was very
that's
likely a
depressing to me.
permanent life insurance salesman on TikTok making
No,
it as like a, well, and
absolutely not.
I think that's what's dangerous is that when people are out there purporting to be giving financial advice, you have no clue what the ulterior motives are there.
Right. I would
And
I would also say that even if we're talking about like globally diversified, like, 80/20 portfolios for
yeah,
middle income with that risk tolerance, I would say that always doesn't apply to anyone,
I agree.
not or like everyone, right? In this case. So like everyone should not have permanent life insurance.
I
Everyone should
literally
not have
wrote red
80/20
flag
portfolios.
instead
Yeah.
of the one size fits all approach. And in all honesty, if you're looking at that in any reputable article, because then I was trying to find other um, articles or quotes to kind of support this mindset. And to be honest, I could not. When I
Right.
was looking, people were like, before even thinking about permanent life insurance, for the love of God, look at term. Like, look at, like, I swear,
Right.
it's just, it's,
So let me speak a little bit too, because I don't like when people just say like this is incorrect, this is correct, and just don't provide the rationale. So let me provide a little bit of the rationale
yeah,
behind what I'm saying or what we're saying about. First, you everyone could I'm sure you can understand that why one or one product should not be used for everyone. Risk tolerances are
ever
not
for anything.
right. Risk
Correct.
tolerances are not the same. Spending needs are not the same, right? Retirement needs are not the same. None of this is going to be the same across the entire population. So when we're just talking in this case about specific insurance needs, right? So when term life insurance,
Mhm.
right? So we're going to assume that the person needs life insurance. So when would you pick a whole life policy over either term life or an alternative investment, right? Like, I mean, or just investing the difference, like term plus investing the
Correct.
difference, or just not having life insurance because you don't need life insurance.
Right.
First, there needs to be a need for life insurance
Right.
in some capacity. Either you need to be looking to pay estate taxes, you need to be providing for your family. There has to be a need for the life insurance. You have to either like you have to need it to provide some value for you. Maybe it just
Right.
provides you comfort and lets you sleep at night, and so forth. We'll
Yeah.
call that a need in this case.
So if
Anyway,
we're looking at like a graph, you've already fallen into the column of like, need life insurance? Yes.
I need
Box has
life
been
insurance.
checked. All right.
I have an expectation that my insurability might dissipate or just completely evaporate in the future, right? So I might be less insurable down the line because I know my family has a history of, some kind of disease
Dementia,
or
what,
some
yeah.
kind of a,
Any kind of,
right.
yeah.
So something might change with my insurability in the future.
Yeah.
Okay, that's a little nudge in that direction. You need to have, well, they've talked about permanent insurance rather than specific policies,
Correct.
but most of the policies that are gonna try to mimic market returns are gonna be overstated for a number of reasons, so we won't really go into those. Let's talk about whole life policies. The ones that we see the most, I guess, are whole life policies, and the selling points are things like you'll hear things like you can bank on yourself,
Yeah.
tax
Invest in
deferred.
yourself. Right.
These are, tax-free, tax deferred, tax advantaged investments. We wanna caution that none of that is really entirely accurate. The banking on your we're gonna have to do a podcast on this
We
and
will.
and line by line talk about it, but note that those things are either overstated or incorrect. And what I mean by that is, like, banking on yourself, what does that mean? You can take loans against your policy, however, you're going to be paying interest on those loans, and the interest you're paying goes to the insurance company. It also can be thought of in the same way that, like, taking money from your left hand and putting it in your right hand is not exactly, like, doing you any favors. It doesn't do anything, right? Like, you're just shifting funds around. But really, when you're taking loans against these policies that have outstanding cash values, um, it, you're still paying an interest rate. So they're not free. It's not exactly banking on yourself because someone's getting the interest and it's not you. Um, the other point to make is that first you also have to be very risk averse. A lot of the growth on these is doesn't it's in the 3% ballpark, right? Like you could do better in fixed income in most
Mhm.
cases. Um, the another the tax deferred. This is one that I really that gets me. Okay, so when you're paying premiums into whole life versus if you were just taking that money and investing it in the market, most of the premium is going to evaporate because it's going to be used to provide for your cost of insurance.
Mhm.
Right, that's a significant portion of the premium. The first year is 100% or more of the first year. We typically go to the
Commission.
agent that sold you the policy.
Yeah.
That's how the commission works.
Yeah.
Okay, then after that if you were to after that, we're talking about the growth, right? We're talking about the taxability, like the tax benefit, right? What tax benefit are we giving? So we're paying our premium, let's call it $1,000 a month. Well, let's assume it's a huge policy, $1,000 a month. If we were to
Mhm.
invest this in the market, we have a cost basis of now, let's say $12,000 a year in
Yeah.
whatever we've been buying, right? And then would pay. So the thought is when I borrow or withdraw from my cash value, that I
Mhm.
would be able to access that money tax free.
Right.
And they're contrasting that with your alternative, which is just we're saying is a brokerage account in this case,
Okay.
investing in stocks or equities.
Correct.
If I pay $12,000 for a stock and then my basis stay or then the stock's market value stays the same
Mhm.
and I withdraw $12,000, that's not a taxable event. There
Correct.
is no gain or loss there.
Correct. Because there's no difference between what I'm getting and what my basis was, what I spent.
Exactly. So it's overstated at best and disingenuous and wildly erroneous at
Yes.
worst.
Yeah.
Okay, does that make sense? So you're not actually doing something in a tax deferred way, and the growth is tax deferred. Yes, you don't pay tax on the growth as it's happening,
But right, because
but
at the
you're
same
also
time,
losing
it's
about
also tax.
60% of your premiums
Yeah.
dollars to the cost of insurance. So
The most important
sorry,
thing,
I went off.
I knew this one would send you there, but I think the most important thing here is to say that, like, if you're looking at evaluating your insurance needs, whether it's a whole life policy, a term life policy, that's not to say that there are not people that will need or may need a whole life policy, right? But it's important to look at that investment compared to other investments you could do with those same dollars and compare those scenarios. Like you were saying, compare what happens with my like whole life policy to if I was to invest in the market, because the difference as it's been explained to you may not really be as
Right.
drastically different as you think.
Right. Just last point here, and it's probably longer than it should be. Is that the use cases? Like, when might you
Yes.
actually use a whole life policy?
Always,
One,
according to this.
right, exactly.
Yeah.
You are maxing out your retirement accounts. Note, I didn't say engaging in the employer match. I
Right.
said maxing out. $23,000 if you're under 50 in 2024.
Right.
Okay. So I'm contributing $23,000 to my active
Hmm.
employer account. I'm probably backdoor Roth IRA, so I'm 7K on that if I'm under 50 in 2024. Um,
So you're hitting all the statutory limits
yes,
for
maxing my
investments and
HSA.
retirements
My
before.
brokerage account is completely flush,
Yeah.
means it's got my emergency fund, capital expenditures for the next few years. It's got down payments on future houses, maybe boats if that's where I'm going with this. Um,
So it's investment C on your investment plan.
it is the last box to check if I'm sincerely like, and I'm super risk averse. Like, I'm ultra risk averse. I
Yeah.
want to take no risk. That's when I'm thinking, okay, you know what? Maybe something like this might make sense.
Yeah.
I just need other things to put my money in.
Hmm.
Because if you need other things to put your money in and you're willing to take risks, you could just invest in like a S&P
Various.
500
Yeah.
ticker, or,
Exactly.
global equity ticker of some sort. So
Or
anyway, very narrow use
GameStop.
cases. Don't do that, probably, right? Like, I mean, if you want
No,
to play with 5% of your portfolio with
but
that,
exactly. But that's the idea. I think it's just if you are looking at that, analyze it the same way that you would with other investments, analyze it alongside other investments.
yeah, mindful of your risk tolerance and time
Correct.
horizons and everything else. But note that the use cases are infinitesimal compared to what they're recommending, which in this quote is literally for everyone, which is
Correct.
absolutely
And
nonsense.
that I think was the concern, right? Like in TikTok videos and stuff like that, we know that there's a set amount of time. And so people want to say things that will resonate with people and that they will hold on to. But to hear anybody saying everyone should do this or
Oh, that
everyone should do
is
that is a problem.
ludicrous.
All right. Last but not least, Eric, super quick. Ray Dalio is
Okay.
quoted as saying cash is trash. Now, the reason
Should I know who Ray Dalio is?
no, just
Okay.
I had someone I could attribute it to.
Okay.
It wasn't a okay.
Yikes.
It's a guy who is writing article. Like
Okay.
he's in the industry. It's
Got it.
not random guy in his mother's basement.
Okay.
But he said cash is trash while expounding upon the idea that um cash loses value over time due to inflation and other economic factors. And so that is one of the last places that we should be holding. So that the old idea of cash under the mattress, right, is like the easiest way to lose your comparative advantage.
I like Ray Dalio.
Yeah.
I like Ray Dalio
Yeah.
kind of a lot.
Had to put him last.
Yeah,
Yeah.
I agree. Wholeheartedly agree. If you're, yeah, I can leave it there, right?
Yeah.
But checking account, you're going to have to be in cash unless you're going to find some bank that's going to pay you interest, but it's usually nominal, and then usually it related to using their debit card, which is going to mean you have to keep money in your account. You get the idea. It's almost always better to just be using a credit card than a debit card for a bank, because the rates are just going to be typically better. The credit cards will give you 2%.
Those are your benefits.
Yeah. So to get checking interest, you usually have to jump through hoops that most people aren't willing or able to jump through. So basically, you want to keep your cash in your checking account, and then everything else should be earning money
Correct.
in a money market, for example, or well, CDs would tie it up probably long. If you wanted to do ladder CDs with your
Mhm.
emergency fund, that's permissible, right? Like, that's
So your
reasonable.
advocacy in any kind of investment um, account would not be to have cash there.
Oh, okay, right. No, I would have it minimally in the money market. Like, my cash portions of portfolios will be in the money market,
Right.
because it's
Because
paying you right now. It's like 514 basis points, I think it
and the
was last time I checked.
liquidity is it's highly liquid. You could still
Right, you get
go
access
use
to it
it.
next day,
Correct.
right? So it's going to trade at the end of the day. They're going to sell at the end of the day, and then it's going to be cash in the account in the next day, and then you can transfer it out if that's what your intention is,
Correct. So if you're
or
worried
purchase an
about,
investment.
because some of the feedback we've gotten from people we've worked with or talked to is, well, I need the cash in case there's a stock that I really want to buy.
There's actually now you can. So the way it works, since stock now settles T+1, which just means
The
the next
trade.
day,
Yeah.
so it essentially settles overnight. And money market is going to become liquid overnight when you get out of it, when you move in and out of that mutual fund position. So mutual funds would trade overnight as well.
Right.
You actually can buy the stock with the money, the money that's being sold in the mutual fund. So I can go into my account, sell money market, purchase stock. So if I can sell $10,000 in my money market,
Yeah.
I can buy $10,000 of Nvidia or whatever.
So that
And
night
I'm
it's
good.
like money market shakes hand with cash, cash shakes hand with stock.
Yes, and you're
So
not short in
instead
the
of
account.
two
There's no
days,
margin
we're
used.
1 day.
Correct. So
Nice.
so
I
you
didn't
can
do
do that
that.
now. Yes.
Okay, well,
So
that's nice.
there's not even a limit where you would have to wait a day to buy the stock you wanted. You can now
Correct.
buy it same day.
As if you had cash.
Right. So it's just you only lose the 5.14% if we're talking about like the fund that I'm specifically referencing
Right.
here but most money markets are in the 5% ballpark. You're
Yep.
only losing 5% by keeping it in cash rather than a fund.
Yep.
And just to be clear, the brokerage houses are thrilled that you did that
Oh, for
because they're
sure.
going to earn the 5% and you're not. Right.
Exactly.
So
Because it's hanging out with them. You're letting them
exactly.
borrow it.
Right.
Exactly.
They lend it at the overnight rate to other
Mhm.
banks.
So yes, but
The
I
federal funds.
thought it was I'd never heard it explained that way. It
I
was
like it. Ray
succinct,
Dalio, well done, sir.
beautiful. But yeah.
All right, guys.
All
If
right.
you enjoyed today's episode, please review the show. And if you have any topics you'd like discussed or financial problems you'd like solved, please reach out to us at podcast@equilibriumfp.com or visit our website at equilibriumfp.com.
Goals. Tongue tied there.
Yeah, a little.
Yeah. Till next time.
Thanks, guys.